scatter plots, show you the Excel sheet, then actually look at my Stellar screen and throw some ideas at you on how to approach the market. Okay, so let me just first of all bring over the Excel that I'm going to be talking about. So what it is, it's just a simple Excel. It uses real-time data, live data from CQG, and essentially what the plan will be to, because of this, the signals are only every 240 minutes, 90 minutes and 30 minutes. You don't actually need this on your desk, right? What you need this is in your office so that you can go and use this, once or twice a day, that you can go and look at, some of the most important spreads that are trading around and are highly correlated to the spreads that you're trading, just to make sure that, you're not missing any pieces to the puzzle, right? So what I've got here on this snapshot is the actual spread that we're looking at. So that's the June 8, June 9 calendar spread. Now, as I mentioned earlier, this could actually be any spread in between butterfly or combo. So for instance, even though I'm looking at the June 8, June 9, and I look at it mainly because it's a little bit more volatile than just looking at a 3-month spread. On the top line, I've actually got the, just a vanilla pricing signal to tell you whether it's bullish, bearish, or not. So just ignore that on the 90-minute, ignore that -5. So basically, on the 240-minute, on the 4-hour, it's just mildly bearish. On the 90-minute, it's quite strongly bullish, and then on the 30-minute, it's mildly bullish. Now, as you can tell, different time frames are going to give you different signals, right? So why I always look at 3 different or 4 different types of time frames whenever I'm looking at anything. So then I've got my actual spreads that I think, or spreads or products that I think or I know I have to be looking at to enable me to trade this spread, clearly being able to see the full picture of what's going on, right? So what I've got here is I've got in each of the 240-minute, 90-minute and 30-minute, I've got how each of my indicators are trading at the moment. If you look at the 240-minute chart, it's quite clear, so on a longer term trend, that there is a mildly bearish trend in all of these products, right? So that's the 5/10 Treasury spread, the 2-year, 5-year interest rate swap spread, 3-year, 5-year interest rate swap spread, 5-year, 7-year interest rate swap spread, the reds, greens pack spread, greens, blues pack spread, and in the 5-year outright future. As you start to change time frames, you start to get different signals, right? You can expect that. So what I do is I want to know what trend was happening either overnight, in the longer term, yesterday, and then it's more, okay, this is what's going on now, right? So that's the actual Excel. So what I've got in here, as I just mentioned, so I've highlighted what each of these spreads are. So just to clarify, so 5/10 is the 5/10 5-year, 10-year US Treasury spread, and I've quoted this in price because in a minute we're going to be looking at it in net change, using a DVO1 ratio between the 5-year and the 10-year Treasury future. I used this. I also could use the 10-year, 30-year spread or 2s10 spread, and I use this because I want to see what's going on in the Treasury yield curve and see what's going on in the shape of that yield curve, because it's going to be highly correlated to the shape of our curve. And then I'm going to look at the interest rate swaps curve, and I'm going to look at 3 parts. I'm going to look at the 2-year, 5-year, 3-year, 5-year, and the 5-year, 7-year. Then I'm also going to look at, which you may or may not know what these products are, so it's a EuroDollar reds, greens pack spread and greens, blues pack spread, okay? The reds, greens pack spread is the spread between the red pack and the green pack, and then the reds, greens, blues is the spread between the green pack and the blue pack. So what I've just got quickly here, I've written down on Excel in the red green pack spread. If you buy one, so it's actually a really powerful tool and a really good way of looking at the market in one snapshot in the Eurodollars. So if I buy one red green pack spread, so it's an actual spread, not an outright price. So if I go to the market and buy one, what it actually does, it buys me, as you can see here, it buys me one lot of every red contract, and it will sell without any legging risk one lot of every green contract. Now, as you can see, that actually is 4 lots of 1 year spreads. Okay, so if each of those 1 year spreads is a one lot, so that's 4 3-month spreads, and then you've got 4 of those. To buy one red green pack spread is actually buying 16 3-month spreads, so it's quite a big contract to trade. And then I've just done some other examples of pack spreads. Major institutions use these products mainly because major institutions like to capture quite a bit of curve in one hit. They don't really like the 3-month spreads, just purely because of the liquidity, and it just doesn't capture enough part of the curve. So that's why they like the 1 year and these pack spreads. So that's the pack spreads, and I've also got in here the 5-year note future outright. Now, right now, the US Treasury curve is kind of caught in between the devil and the deep blue sea in terms of, are we fully in a hiking cycle where you would probably see, if the 5-year note future got sold off, the curve would flatten from reds to golds and greens to golds. And it's caught in between there and the phase where you're in this part where if the Treasuries goes down, the curve steepens still. Okay, so the curve would go up. So we're caught right there. So until we get some sort of clarification or further clarification from the Fed that they're going to continue being dovish. You know, if we continue being dovish, we're going to have more of what we have now. Now, if inflation or oil picked up to $50 a barrel, you're going to see a different story, right? So you're going to see a situation where the Fed will probably get on the front foot and be a little bit more hawkish, in which case, if you start to see the 5-year note future getting sold off, you would expect to see the green spreads and the red back-end red spreads probably getting sold off with it. So I know, right? So I know over a very long period of time that these indicators are highly correlated products. I know that you know on Stellar you cannot trade interest rate swaps, but these are highly informative products. The US Treasury, the US interest rate swap curve is extremely liquid, and the major institutions that are trading and hedging their interest rate swap needs will be using these products. It's very important that we know what's going on in them. So what I've got now is I've got a number of charts, and hopefully they're going to be useful for you. There's a number of charts which, just to show you, say, you know, that I'm not talking nonsense, to show you that the correlation between each of the indicators visually, what they look like. And I encourage everyone to either make and I've given you the codes, either make these spreads yourself in Stellar or in the Office CQG. And I really encourage you to do your own research as well. With any questions, please let me know. So up here, what I've got in the top in these 5 charts, right? So I've got the June 8, June 9 Eurodollar on a 240 minute, and then opposite that, on the right hand side of that, the 5s, 10s. You can see, although every lump and bump and move up and down is not exact, well, you know, one's a 5-year, 10-year spread, and one's a June 8, June 9 Eurodollar spread. However, the general, like on this 4-hourly chart on these top 2, you can see that there's a general and a consistent correlation between the two. Now I've then put a chart on the 90 minutes, an hour and a half. You can see that on the short term, that correlation remains, right? So when one is going up, generally speaking, the other is going up. On the bottom, I've done an analog overlay, which you'll find on CQG, of the 5-10 spread and the June 8, June 9. Again, so sometimes you can see the correlation between products with numbers. Sometimes you can have them side by side. And sometimes you need to overlay them to be able to see the correlation between the products. Okay, so what I've done is a combination of all of that. So that's the 5s, 10s. You can see it's a correlated spread. If I was trading, or when I'm trading EuroDollar curves, I want to know what's going on in the treasury spreads. So what I've got now is I'm going to flip through these 3 interest rate swap spreads. As you can see, same story. I put the EuroDollar June 8, June 9 on the top left, the indicator spread on the top right. They're correlated, they're moving up and down together. And then on the bottom, I've got an overlay on a 30-minute on the short-term perspective. Now, I've done that for each of the 3-year, 5-year, against the June 8, June 9, and I've done that for the 5-year, 7-year. I don't need to keep going over the same spiel every time, but needless to say, these are correlated spreads that we need to look at. So what I've also got, and this is going to be quite obvious, but the reds greens pack spread. What I've done here is I've created a reds greens pack spread in price. Now it's important to mention that because the EuroDollar pack spreads and packs and bundles on the CME are actually priced in net change. So they work out what the previous, or they have this previous settlement, and they calculate how much the price is right now from that previous settlement. So everything's in net change, which is okay on the day, right? If you get in and it's trading unchanged and starts going down to down 1, you know that it's going down, but you don't know how down 1 refers to yesterday's pricing, right? So it's always in Stellar, create these pack spreads using the formula I use to create them in price, because then you can track how they correlate to your product, right? So this is the reds greens pack spread, same story, correlation or looking at how they correlate to the June 8, June 9. So what I've got here is the June 8, June 9 on 240 minute. Again, same story. When one's going down, the other's going down. And then I've got the green blue pack spread. Again, curve steepness, curve flattening, and these generally happen or usually happen at the same time, right? So that's enough for the PowerPoint. This Excel and approach and knowing where to look for signals and how to use these signals. Although, you know, this is Excel will be plugged into the Office CQG. I think you can generate most of these signals on your Stellar, right? So once you start to get comfortable with knowing what to look at, what's correlated, you're going to be able to easily bring this in as part of your trading. So what I've got here is I've got a Stellar setup, right? So it's not perfect, as in, you know, it might not be a perfect layout for you, because I know you guys use Matrix a lot. So what I was going to, so the point, actually, sorry, before I go into that, I want to go through some scatter plots, right? So, okay, what I've got here is, and I'll show you in a second once I've logged out of Stellar, and I'll show you how to create these, right? These are really quite powerful learning tools, and I sincerely hope that once you've watched this, you can go away and actually start doing your own research on these. Okay, so here is what I do is I export the data of two products that I want to see. In this case, I've got the 5s, 10s spread in price, and I've got the June 8, June 9. You can tell by the tab there, right? So what I've got here is I want to know, or I want to see, if I scatter plot these two together, the shape of, you know, how they correlate to one another in time. Okay, so this is a 15-minute chart. what I've got here is I've got the price of the 5s, 10s spread on the bottom. You know, you've actually divide that by 1,000, so it's 102, 120, which is current. Actually, it's around this price now, about 102, 130. And then on the vertical, I've got the price of the June 8, June 9, which is 24 bid at 24.5, right? So this is where we are right now. Price of 5s, 10s to the price of the June 8, June 9, right? So how does this help me? So what I'm going to do is, I mean, I've been trading a long time, so I should know how these products correlate to one another, right? But if you haven't traded these products for a long time, what I could get from this Excel, this scatter plot, is that as the 5s, 10s spread goes higher, i.e. from left to right, I would expect the price of the June 8, June 9 to go higher too. Okay, so this is where we are right now. June 8, June 9 is 24. The 5s, 10s spread is 24. 5s, 10s spread is around this level, about 13. So I would expect that, obviously, you know that the spread should be positively directional to the June 8, June 9. But what I would expect is so I now know it's directionally important. Then I can start to say, plot, well, where do I think is a good level, a topish of this EuroDollar spread? So not to sit there and pick levels and punt, right? But to give me a good feel of when I'm starting to put on a combo or a strategy. Am I getting in on the higher the market or the lower the market, right? And why I mention that is, let's say, for example, a very simple strategy here or concept to build out would be, well, if the June 8, June 9, or while the 5/10s is in this range of 12 to 14, if June 8, June 9 gets up to 25.5, I would expect that to be toppy, right? So I'd expect that to be a little bit on the. I would start to sell it, so I think that it was expensive. Conversely, if we started to see it down to 23, okay, so all of a sudden, from one Excel to two Excels, because the other one was the correlations. So we've got two Excels. Now this Excel is going to start to give you potential relative value of the June 8, June 9. Now, when it's really boring and quiet like it is today, this might not be any use, because it's only going to trade 24s and be 23.5 bid at 24.5, 100,000 lots up. But when it starts to get busy, that's when these things are really useful, right? And you can not only do this for spreads, you can do this for boxes, for combos, all sorts of strategies, right? So if you can start to value products to one another, so let's say you've got your spread that you trade, I don't know what it is, let's say it's June 8 SEP 8, you can then, that June 8 SEP 8, you can then say, right, I want to look at 10 different products and I'm going to start to plot a range relatively of if let's say the Treasury 10-year goes up a point, where do I expect the June 8 SEP 8 to be trading? In the recent history, where was it trading? To give me an idea of the range. And if you do that with all the products, you're going to start to get an overlapping range and get a good confidence of where potentially some of these products are good value. So I've done this again for a couple of other products. So here I've got the June 8, June 9 on a 15-minute to the 5-year, 7-year interest rate swap spread. Now, I took this data from it and there was literally nothing going on, right? So it's quite a quiet period in time. So what we've got here, the current price is around 31.6. So so actually it's about 31.9. So what we've got here is I'm expecting that if the 5/7 year goes to a price of 31, I would expect starting to get a slower range, because there's a slight. It's if you look from right to left, you're starting to see the values going down. There's more values on the lower left hand side. So if I expect to see the price of the 5-7 year go from where it is now, 31.9, 32, down to 31, I would expect that the EuroDollar M8, M9, June 8, June 9 will be in a slow, lightly range, in a lower range. So my prediction would be, or my thinking, right, is that it would be 22 bid at 24. So more like 22 bid at 24 rather than where it is now, right? So it's ever so subtle, but you would definitely see a change in the distribution of the price action. So what I've got here, I've got another example. I've got the June 8 SEP8 spread, but now I'm going to do two similar spreads to one another. So what I've got here, I've got the June 8 SEP8 spread on a 60-minute, and I'm going to correlate that to, and I'm going to, plot that to the June 8, June 9 spread. So why I'm doing that is, let's say, for example, your favorite spread is the June 8 SEP8. You can start to go into CQG and start to look at my June 8 SEP8 and where's the range of this product. Of course, it's going to be positively correlated, i.e. you're going to get a slope from top right to bottom left. And then interestingly, I've done the SEP8 decade to the June 8, June 9 as well. I think you get the picture. These are quite powerful ways to look at, especially new spreads, right? Or what you can do is look at new spreads on the short term, or what you can do is look at these new spreads on a longer term as well. So maybe look on a weekly or a monthly perspective. So back to the Stellar. So what I've got here, I've got from left to right, I've obviously got this price view. This is listing all the spreads on this page. And then I've got a couple of charts. So I've got the June 8, June 9 EuroDollar on a 10-minute, and then I've got a 60-minute chart of the June 8 decade, June 19, Dec 19 fly, so double fly. Okay, so what have I got here? So on the far left-hand side, I've got the reds greens pack spread, right? So we talked about what that was. A reds greens pack spread is this structure, right? So if I buy one of these upper quarters in this pack spread, I would actually be buying one of each of the red contracts and selling one of the green contracts, right? So I don't really want to be doing that, but okay, so that's telling me that's my spread. That is going to be capturing on a net change basis all of the spreads between June 17 and March 18 1-year spreads, right? So it's quite a powerful way of capturing the curve, right? Because remember, your 3-month spread still may be like this little baby in the middle here, June 18, June 19, 122,000 by 111,000. But I can bet my bottom dollar that if this green pack spread goes to down halves or up ones, these are going to be worthless. Either one of these prices will start to become worthless, right? So I want to keep my eye on that. That's a big part of the curve. Right next to it, I've got the 5-year, 10-year note spread as a spread. Now, what have you noticed here? Like the red to green pack spread, this is in net change from previous settlement. So again, this is in net change from previous settlement. So it's very important to note that if you buy evens today and you sell up twos tomorrow, it doesn't necessarily mean you're going to be making 8 price ticks because it moves in quarters. It actually could mean you've lost money depending on where the settlement was, right? So it's very important to know. But what this is telling me today is the reds greens packs is telling me it's slightly bullish. Slightly, it's only up a quarter, so that's 1 3-month spread in that whole 1 year that's slightly steeper or trading on the offer. You've got the 5s 10s spread, you've got that's up nearly 1, right? So that's steeper, that's mildly steeper, higher. You've got this spread here. This is the reds, that's actually the reds blues pack spread. and that actually was trading a little bit lower this morning when this 5s10s was trading down here. So if you look here, the 5s10s low was evens on the day, and this reds blues pack spread was down here at down 3/4. Now, as this 5s10 spread has gone up, your reds to blues pack spread has gone up too, right? So it's not a huge amount, but it is London morning, so this is a fair type of move. But what you can see, this treasury spread is telling you and helping you with the direction of this reds to blues pack spread. And yeah, so it's giving you some vital information. This spread here is the June 18, June 19 Eurodollar spread, right? So this is all morning when the 5s10 spread was trading down at even. If you see where my mouse is, this was like 24 offered, and now this has rallied up. This is now 24 bid, and you know, the thicker, if this trades ones, if this goes 1 bid, 1/4 trading, this is going to get even thicker still, and this 24s and a halves are going to thin out on the sell side, right? So, and again, you know, next to this, I've got June 18, June 19, and SEP 18, DEC 18. June 18, SEP 18, and I've got SEP 18, DEC 18. What you've got here are the two big 3-month spreads, hundreds of thousands of lots up, which probably on the face of it don't tell you a lot, right? And I know a lot of you work orders in the book, but what can help you is these indicators over here to the left, right? They're going to help you know, is my order good, right? I know I'm front of the queue, or I'm well at the front of the queue, but is there any value in it, right? I'm not going to give away my edge and give away my place in that queue just for nothing, but certainly I'm telling you, if this spread here, the 5s10s goes up to up 2s, reds greens goes up to up 1s, this offer, even if you're the front of it, this is going to be rubbish, and probably the value will be looking to buy that to sell into a 9-month to put on a double fly, right? Again, that's a few steps forward, right? So, and what we got here, we got the 9-month spread. So why have I got the 9-month spread? Because I like double flies, right? I like, which I think you guys call combos, I like buying a 3-month spread and selling in 3 lots and selling one of the 9-month spread around it. Okay, I like that. I like creating combos, these double flies. They're very safe, they're non-directional plays, and I think people should look at them more often, right? So, okay, so that's how I look at the curve, right? So right now, you know, the curve is doing not a lot, right? So we've got the treasuries there, they're trading lower and lower on the day on the downside. So it's kind of pushing the front part of the curve up a little bit. If you can see here, the reds greens pack spread's gone slightly bid here. You've got the reds blues pack spread, that just went bid at evens. You're probably going to get a 5s10s bid there up a 3/4. So what's that telling me to do? I mean, there isn't a lot to do, right? A lot of our work is working orders, keeping good queue, trying to collect edge on the bid and ask, right? So right now, what I'm doing here, what I also got here actually, whilst you're with me, is I've got my double fly price. So actually on CME, you've got a book of double flies. So you can go into price view and select D fly, select all, and it will give you all of the double flies that are quoted. So they've got all the 3, 6, 9 and 12-month double flies that you can actually trade on the CME and the Eurodollars. So these are traded, right? So I know there's no volume this morning, but that's a boring UK morning when there's not a lot going on. These are traded, right? So you can either trade around them, so you can collect edge and scalp into that as your stop loss, or you can actually use them to collect edge, right? So sometimes people come in and they will cross the bid ask in these orders. Now, what I've done, I've calculated where I think are good levels, right? So where I think are good levels, right now, good levels are 2.5, 3, right? Because there's nothing going on. But what I've got, I put a bid in on the 1.5s, and I put an offer in on the 4s, okay? And this is the June 18, Deck 18, June 19, Deck 19 double fly. So a 6th month rather than a 3-month double fly. That's where I think are some nice levels. Okay, I think now I've met an awful lot of you, right? So there is a general blend of people and traders who are very proactive, right? So some of the most proactive traders I've seen in the industry, I've seen working at OSTC. Okay, so, and then I see a combination of traders who like to pick good levels and sit there and wait, a little bit more patient. But what I think that the most important thing to do is combine both, right? So is, you know, collect. I think one without the other is extremely difficult. I think if you sit there and you're very patient and you're waiting 3 or 4 days for a level on the fly, or even 8 days for a level on the fly, you know, you're almost in that game of predicting. Okay, so why you know, why there are hundreds of thousands of people on this bid on the -1.5s, right? There's 150,000 lots on this bid to buy -1.5s in the June 18, SEP 18, Deck 18 fly. There are not 150,000 one-lot people, I know there's bigger traders, predicting that is the bottom of the fly. What they're predicting is right now, that is good value, right? So that pretty much is it, right? So what they're trying to do is capture a bid ask. So I'm not going to belittle what we actually do as traders, but I think yes, we do pick levels, and we have to pick levels and be confident in the positions that we inherit, because we often inherit stuff that isn't brilliant, right? As the market's moving fast, we just sort of leg it and hedge it into something just to be safe and unwind it a little bit later on. But I think the vast majority of the most successful traders at OSTC are collecting edge, right? So they're almost like, it doesn't matter what the bid ask is, they're looking to capture that bid ask and they're being active. So that doesn't mean to say that being patient and sitting there waiting and putting on a trade is going to be successful. It is not going to be successful. But what I am saying is that, you know, I think the value of the bid ask is far more important. And why I will confirm, I can help you with that is, look at this, right? So this here is the 3-month set deck spread. Again, you know, 113,000 lots on the bid, 114,000 lots on the offer. That isn't two people that isn't two people saying that 6.5s is going to be the low and 7s is going to be the high. What that is people queued up and they're basically saying, if I sell 7s, I'm going to buy this, that, or the other against it. I'm going to take a very small edge. The vast majority of the most successful traders in stirs are collecting little edge the whole time. Sometimes you get big edge, sometimes you get no edge, right? Sometimes you have to go all day making good decisions. But the most important thing is to continually make those good decisions, because without working these orders in the book, you won't be able to get those edges. Right, that's that. I'll load this into Universe for you, or obviously you'll be listening to it, and yeah, we'll take it from there. Thank you.